does underwriting work for commercial loans? First and foremost, it's really going to depend on whether the property that you're buying is either owner occupied, where you're going to occupy 51% of the property, or if it's an investment property where you're going to be using the cash flow of the property. So let's talk about owner occupied. Owner occupied is when your business is going to purchase a building that you're going to run your business out of. That cash flow is based on the cash flow of your operating business and to make sure that your business itself can afford the rent and mortgage payment. Then on the other side, we have investment properties. Investment properties, there really is no business because the business is the property itself. So that is based off of what kind of cash flow will be generated from that property, also known as the NOI, or the net operating income of the property, which is the net income. Other things an underwriter will look at is the property type. If it's retail, if it's industrial, if it's office, is it land, is it whatever type of property, each different property has a different thing that we want to look at when it comes to vacancy rates and what are we going to look at for a worst case scenario. We're also going to look at the condition of the property. Is it in really good condition? Is it brand new? Is it a very old building? All of that has a different type of risk too, based on what kind of maintenance will be involved and how do we look at that from the underwriting process. The location is also another factor. Is this located in the middle of a rural area, which it's a little bit harder to maybe get tenants or the resale value? Or is it in downtown Seattle where there's a lot of occupancy and a lot of different people that are coming by that could actually rent or use the facility? Another thing is environmental impact. Is there any sort of environmental issues on the property? We also look at the guarantor, also you as an individual. What kind of strength do you bring to the table when it comes to the loan? What is your cash position? What kind of retirement assets do you have? What's your net worth? And we look at your liquidity, which is how much money you actually have in the bank ready to use for any sort of emergencies that property would possibly need. We also would look at your experience with these types of properties. If you're purchasing an office complex, have you ever owned an office complex before? If it's a rental property, we want to see what your experience is in that type of property. In general, we look for 3 different ways of repayment: primary source of repayment, secondary, and tertiary. Primary source of repayment is if it's an owner-occupied business, the business itself, can it provide enough cash to make the payment? If it's an investment property, the cash flow of the property. Secondary source of repayment is you as a guarantor. What kind of income do you generate from your W-2 employment? Maybe you have other rental properties. That's your secondary source. And tertiary support is if we ever did have to take the property back, do we have enough value in the property that the bank can be made whole?